There's less than 60 days left until the year is over, and 2022 took a lot of people by surprise. Now, I know some of us are claiming that we knew this was going to happen. Listen, I don't think anybody knew how fast things were going to change. I'm going to take a look at data in terms of York Region, Toronto, and Durham, how different asset classes performed, and then we're going to take a look what the future holds for 2023. You're going to have to excuse the clickbaity title. We're not going to have foreclosures. We might have some power of sales next year. They're kind of trickling in right now. But let's get into this. Hi, my name is Vas, and I'm a chartered professional accountant by training. However, I'm a full-time real estate broker right here in Toronto, and I help people like you navigate through the craziness that we call the local real estate market. I'm going to spend most of my time in this video talking about who benefited in real estate over the last little bit and who's likely to benefit in the future. And I'm talking mostly about those of you looking to upsize and potentially first-time home buyers. The question is, when is the right time to buy? I'm going to go over a market update in terms of what I'm seeing, and I'm going to give you some anecdotal examples of how the market is shaping up on the ground floor as I see it right now throughout September, October, and going into November and December. My view may feel like it's biased because I am a realtor. However, I've taken a lot of time in the last little bit to talk to different people in the industry, lawyers, economists, and for me, it's important to have context that is not just within the real estate bubble, which sometimes we all know can be biased. I'll give you what their takes are and what they think is going to happen with the real estate market over the long term, especially with interest rates. In terms of basic market dynamics, in terms of what's happening, stats are showing us already that sales volume is way down. So in terms of deal flow and closing transactions, you can ask any lawyer, real estate person, mortgage broker, everybody's deal flow is way down. My business has dropped significantly, but mind you, we are coming from the crazy highs of 2021. There's still business, there's still buyers, people are active. However, everybody's being very cautious not to overpay for a property that you may pay X for now and it's worth less in the next few months. The big takeaway, at least from where I sit, is that the interest rate hikes that we've had up to date have not really been flushed through the system, and they're not reflected in the prices that currently people are still asking in the market. But to recap, who benefited in 2021? It was the downsizers. Anybody who sold a detached and went into a condo or into a smaller property, the spread between these property types was so high that they benefited the most. The spread is now closing, and it's kind of like the tables are turning. So it looks like now 2023 may be the year of the upsizer, or those looking to move from condos or smaller properties into bigger ones. The issue obviously is going to be affordability and purchasing power. While the spread is narrowing, interest rates are going up. I don't know for how much longer, but they are eroding a lot of purchasing power. So we're going to take a look at different areas of the GTA. Now, I'm not going to spend as much time focusing on the actual percentages and absolute dollar amounts. I think the chart speaks for itself. I'm looking to show you the trajectory of the movements, of price movements. This is for Durham, Toronto, and York region. I don't look at the West End because those are not areas I work in and I'm not as familiar in. However, as you can see across the board, the story is the same, except Toronto is holding up a little bit better, but that is to be expected. Toronto didn't go up as much as York region or Durham. To me personally, the more interesting story is at the property level in the different regions. So if you take a look at York region between townhouses, condos, condo townhouses, detached, and semi-detached, you will see that the spread between, let's say, a condo or a condo town was significantly bigger in February than where it is now. So the spread is narrowing, making this a much better time now for anybody thinking to upsize to actually do so. Not necessarily right now, but maybe in the coming months, if you're thinking about it, this is actually a good time to start considering it and getting a little bit more serious if the right opportunity presents itself. So in the city of Toronto, looking at property type, I can tell you just from anecdotally working in the city, mostly in the East End, is that there have been some fantastic deals on detached properties, mostly by way of old inventory that needs a lot of work. Anything that's turnkey generally gets picked up fairly quickly, and desirable product is always going to be desirable. For the most part in the city of Toronto, it goes. But on the detached end, there have been massive spreads where if you buy something that, as an example, is $800,000, it's detached and it's close to a subway station, and you put in $200,000 for a total after renovation $1 million, you're creating something that's currently selling at $1.2, $1.3 million. The city of Toronto, I think that's where the opportunity is going to be right now. In the 905, product is usually newer. It's not as in dilapidated shape, so there is not as much opportunity to force value by way of renovations. Something to keep in mind, but that is kind of what I'm seeing in the city of Toronto right now. The story in Durham is probably the most fascinating one because Durham's detached just went through the roof, but you're seeing the gains they're giving up are massive, and I don't think we're done yet. So the spread between condos or condo towns is narrowing, and it's going to continue narrowing, and I don't think condo towns or cheaper properties are going to drop as much on a percentage basis going into the future. There's always demand for properties under a certain amount. A snapshot right here is more relevant for people like me or people in the industry, but this is to show you historical sales volume. Right now in October, we're pretty much at the sales volume that we were during COVID. And I mean at the start of COVID. This is where we were in terms of sales volume, about 2,000 transactions. We're now at just over 3,000, and we're entering the winter when seasonally we go into much, much lower transactions. So I'm very interested to see where this ends up right now. I have a feeling the next few months are going to be very, very quiet. This could be opportunity for some of you that are looking for deals. Generally, in my experience, my best deals have been around Christmas time where nobody's really shopping. And if you're listed around this time, then usually you need to sell. You're very motivated. But yeah, this is the story that's unfolding. Deal flow is way down. This could be opportunity for some people. The next story is the average days on market. How long are listings staying? So I can tell you right now in the condo market, it's really slow. So condos are moving very slowly, and days on market is actually growing. And my personal favorite chart, we know realtors love saying sold over asking or sold over list. The most meaningless thing to say, but you know what? People, the consumer, they're still eating it up as if it's relevant. The only thing that matters is that you sell over market. So if the house was worth 1 million, if you got 1 million and you listed it for 800,000, like who cares? You just sold it at market. Good job. I mean, I don't know what to tell you, but we know people love it as a marketing ploy, so I'm glad that this is kind of coming to an end. So what you're looking at here is the dark blue lines are sold over asking, and as you can see, 2021, the entire story was about selling over ask, and the gray is for selling under ask. Effectively, this is just telling that people were underpricing properties to get a bidding war, and here we are now. And as you can see right now, most stuff is actually selling below ask, and a few things are selling over asking. So this is where you're having successful bidding wars, I'm assuming, probably for product that actually moves half decent. As much as I hate to admit it, still underpricing properties on properties that are desirable, it still is probably the better sales tactic. COVID, as you'll see right here, the dark blue line is your average sales price, and this was your list price. A lot of cases you're looking at 10 to 20% discrepancy on average. It's funny because in some cases people will be like, hey, well, if I want to sell my house for 1.5, then I need to underlist by 20%. There was actually some sellers used to think like, hey, just the common rule of thumb is just misprice or underprice by 20% in order to get the amount you want. And it's not necessarily true, and underpricing is a double-edged sword. You can overdo it and actually alienate a bunch of serious buyers that are just not going to compete with 60 offers, for example. So there's a bit of a science to it. But thankfully, it's kind of coming to an end right here. As you'll see, we're now kind of listing and selling in and around the same range. To wrap some external context around all the stats we just saw, we already know we're likely in a recession. You hear it from different people. But I find this chart very interesting. We already know new construction starts are going down. Transactions in general are going down. So these are the first areas that are impacted. I can't say that I'm seeing renovations fully slow down, but we know that the number of permit applications is actually going down. And you have your other discretionary spending that's also starting to go down. So these are the super sensitive. These are the ones that are already feeling it right now. In terms of whether or not we're going through a recession, it's pretty safe to say that we are, if we're not already in one. The bigger story, I think, is personal savings rate. So I know that during COVID, a lot of people were able to save a lot of money, and some people will argue that people have so much savings that they can weather the recession or at least kick the can down the road. This is a US chart, but I think it's relevant for us. Savings rates are going down, and let's not forget that inflation eroded a ton of savings, and now a lot of people are also going back to work, whether or not it's hybrid or not. You're starting to incur a lot of additional costs that you did not have for the last year to 2 years. Over the last few months, I've spent a lot of time talking to different people about real estate, the industry, mostly to get away from my own echo chamber of realtors that talk about real estate. And I think one thing is very certain from people who have been through multiple of these cycles, whether it's in the 80s or the 2000s or 2008, the one common theme here that everybody can agree on is that these interest rates that are right here, right now, are here to stay. And what do we mean by this? Whether or not we stop hiking rates by the end of this year or early next year, it doesn't really matter. For one, the rates that are here now have not flushed their way through the system right now, so they're not reflected in the housing prices that we have right now currently. Personally, I feel that is true because we have very little inventory, which is what's supporting prices right now. But then the other thing is that, let's say we stop the rate hikes, what ends up happening is, historically, what I learned is that even after rate hikes end, the government doesn't just rush and start cutting rates. That means we're going to have another 6 to 12 months of these existing rates where the governments are going to watch and assess what's happening, whether Canada or in the US. And at that point, they're going to decide whether or not it makes sense to decrease the rates. And even if they decrease them, it's probably going to be by small increments, not by 50 basis points like the moves we've seen recently, which seem small, but in reality, they're massive. Usually we're moving at 25 basis points. I think the bigger story for 2023 are going to be people renewing their mortgages. To be honest with you, a lot of us who are on fixed rates right now or variable with static payments, even though interest rates have gone up, for those of us with variable rates with static payments, we haven't, okay, you might have hit a trigger rate, but your payment's pretty much the same. Your amortization is much longer, but nobody has really felt the monetary pain of a bigger mortgage payment. This is going to start happening as people with low interest rates, 5-year amortized mortgages from 2018 start renewing in 2023 at 2 to 3% higher than what they're originally paying. And that's going to be an issue. And I think the regulator is already seeing that because they're debating towards the end of 2023 potentially allowing people renewing their mortgages to re-amortize their mortgages. So for example, if you just started a 25-year mortgage in 2018 and you have to renew 20 years in 2023, they might allow you to actually extend that amortization. I don't know. Right now it's just speculation. Whether or not it happens, I don't know. But for sure, people renewing their mortgages in 2023 are going to be seeing substantial increases in their payments. And we have not seen it just yet on a massive scale. I know the title of this video was clickbaity, but obviously things are not looking very good. And to be honest with you, I think a lot of us need to take this seriously and prepare as best as we can. To put the bad news aside, or not so much the bad news, this is just the reality, and I think it's just part of the cycle. We have to understand, personally, myself, I'm bullish on Toronto real estate, but I'm not oblivious to the fact that over the next little bit, I don't know how long, we're going to have some challenges and we're going to have to deal with them after being drunk on low interest rates. What I'll leave you with is that you don't have to outrun a bear. You just have to run a little bit faster than the slowest person. And I think this is going to be very relevant to kind of survive through what's going to happen over the next year or two in order to make it through this real estate market. If you have any questions and if you like the content, please subscribe, like it, and you can always reach me. Ask me your questions direct. I love chatting real estate, and I'll see you in the next one. Thank you.